Welcome back. You're with us on Trading Hour. Let's welcome in our next guest on the show. Manish Jain, Head of Fund Management for PMS and Equity Advisory at Centrum, joins in to talk about the fundamentals in the way ahead. Manish, good to have you on the show. Thank you very much for joining in. So I believe, of course, you're recently in the new job, recently, taken on this role, this mantle. So tell us, what's the view from the top? What's the thought process when you're looking at the market at the current juncture, current valuations?
Yeah, so there is a long and then there's a short of it. I think from a 3 to 5 year perspective, I'm firmly in the camp that believes that the India story kind of remains absolutely intact. I think we are destined to grow at somewhere close to 6% as far as the GDP real terms is concerned, about 10 odd percent as far as nominal GDP is concerned. So we'll go to 5, probably $7-8 trillion in terms of size in the foreseeable future. But from an absolute near-term perspective, I think the view from CY24 perspective is that the markets may not be as linear as they were in 2023. I think we are at a very critical juncture where there are certain risk factors that will probably play out in the next 6 odd months or thereabouts. So it could be where the markets do go in for some sort of a temporary correction. And my view is that investors would do well to grab onto those opportunities and use that as an opportunity to build positions from a long-term perspective. Post-elections, pre-budget, that would be around the time when the Q1 earnings are coming through. We'll see margins kind of tapering off. That would be the first where I would look for a correction. And second is in and around the harvesting festive season, which kind of coincides in end October, early November. That would probably be the second time, and I would kind of look for a correction in these markets. So it's going to be a little choppy. It's going to be a little sideways, driven also by liquidity, probably a little bit of disappointment on the rate cut expectations, as well as the earnings momentum kind of tapering off in the first half.
So now is not the time, Manish, according to you, to put lump sum investments. Perhaps around Q1, when there could be potential earnings disappointment, that would be the time to invest discretionary money into the markets. And if yes, what would be your preferred themes at that time?
Yeah. So I would go in for staggered at this moment from, say, a 3-month perspective, but at the same time, my strategy is going to be more bottom-up than top-down. And that's how I'm going to be looking at the market. So there are pockets of value which still exist. So if you look at BFSI, if you look at autos, the rally in the last 12, 15 months have not really been very, very homogeneous. So in the small cap space and in the large cap space, there are definitely pockets of valuations which are very compelling, and they still kind of exist. And my favorite themes would still remain unchanged in the way I'm looking at 2024. I would prefer autos. I think they should continue to do well. Urban consumption, discretionary consumption, leveraged consumption, real estate, I think those kind of themes continue to do really well. Pharma, we are just at the juncture of start of a cycle. I think that's, again, another area that we should look at favorably. And then finally, IT, I think that's, again, coming out of a very long lull. Finally, the US economy is kind of settling down. The expectations are all settling down. The spend should come back. And the margin pressure is behind. So those will be my favorite bet. In BFSI, I'd be very, very bottom-up driven, very value-driven. Prefer NBFCs over banks. But within banks, again, would be very, very conscious of the price to book multiple that I'm paying across the board in private sector.
Okay, got that. Manish, I was just looking at the portfolio, and if I've got the right fact sheet, I think for the flexi cap, scheme, some of the top holdings include an APL, Apollo. You have Trent, which should make your investors really happy, ICICI Bank, and maybe even HDFC Bank. So just, expand on this point about, what has done well and what perhaps still has value. So is this a market where you should stick to what has been doing well? For instance, a stock like Trent, I mean, I'm just taking that as an example, right? Yeah. And there's been a, absolutely phenomenal runaway, even in the stock price, along with earnings. So do you stick to what is working, or do you hunt for value?
I think it has to be a mix of this and that both. It can't be a one-way strategy. There are 2-3 things that have happened in the last 3 years which are very, very clear at this juncture. One is that the sector rotations have been very rapid and very intense. That's one. And second is, growth at any price is the value, philosophy that doesn't work in these markets. It's more about growth as reasonable valuations. And we've seen that happening across multiple sectors and stocks where the valuations were super expensive and the growth has slipped even a little bit. I think the multiples have kind of contracted very sharply and those stocks have underperformed very, very significantly. So as an investor, what I would do is look at a balance between growth and valuations. Wherever I'm still comfortable with the growth persisting at the current levels, those are the ones that I'm going to hold on to. But at the same time, I'm going to be in that camp which is going to start tilting more and more towards value and look at bargain hunts in these markets on a relative basis, stocks that have not done well from the last couple of years perspective, but still have a great future from a 3-year perspective, even if it means an intermittent 6 months sort of an underperformance where the business is still settling down. I would kind of go for that kind of a bet from a bottom-up perspective. So yes, tilting more towards value rather than aggressively looking at growth at this juncture.
Since you like auto, M&M has done very well over the last 2 days. There is a lot of optimism surrounding their UV volumes, and today they've entered into a supply agreement with Volkswagen for components for their new EV platform. How would you approach a stock like M&M and this news flow about the Volkswagen supply, tie-up?
Yeah. So autos is going to be very simple for me as a bet, right? The Indian consumer, as far as autos is concerned, whether two-wheeler or four-wheeler, has undergone a massive amount of change in the last 3 or 4 years. There is a definite premiumization story that is kind of playing out. Affordable UVs, electronic vehicles, and all of these angles have kind of come in. And that's where you see some players who've traditionally been regarded as laggards in the passenger vehicle segment have kind of taken over the lead as far as the established players, people who have a 30, 40, 50-year leadership track record in autos. They've kind of been left out and left behind a little bit. So whatever stock I pick in the autos, my strategy is going to be very simple, which is going to be of a very urban-centric play. It's going to be more of a premiumization story. People who've shown and demonstrated a track record in the last 3 years in terms of being proactive as far as the affordable UV segment is concerned, as far as the electronic vehicle segment is concerned, and whoever kind of fits the bill in terms of these 3-4 check marks, I would probably go in for that bet, be two-wheelers or four-wheelers.
Thank you very much for joining in. We need to slip into a very short break. On the other side, we'll get chatting with the management of NIIT Limited. This is a company which focuses on B2C, the skills in the career business, and the stock is higher, close to about 8%. Came out with numbers a couple of days back, but we'll get chatting about the way forward for NIIT Limited on the other side.